Hello there, everybody. My name is Dave. I am a business analyst here at Big Red Book, and today I'll be bringing you through a webinar on My Future Fund, the auto enrolment scheme. Now, just before we start, so this recording today will be recorded. It will be shared afterwards, including the slides. It'll take a couple of days for us just to get that ready, so it will be shared and there'll be an email sent out regarding it. Um, for questions and answers, there is a question and answers button on the Zoom screen. There's a team here who will be answering live during the session. All the answered questions will be visible to everyone, and also all Q&As will be shared after the webinar also. Just in terms of the scope of this, look, we're not NERSA, we're not DSP, so we can't answer every query, especially if it's going to come into individual circumstances, why certain rules are in place, that kind of stuff. The focus of today's webinar will be just to cover the basics of auto enrolment, the My Future Fund, so what you can expect, how Big Red Book Payroll will help you make that process simple and straightforward. And just as a little disclaimer, so we may share suggestions today, but for any company decisions, as always, please seek professional advice from like accountant, pension advisors, financial advisors, and so on. So, getting into it, what is My Future Fund? So Ireland's auto enrolment pension scheme is called My Future Fund. It's a step forward in improving retirement savings and financial security for all workers in Ireland. So as the initiative evolves and expands, it will be expected to play a crucial role in ensuring individuals are better prepared for retirement. The go live is January 1st, 2026, and a statutorily independent National Automatic Enrolment Retirement Savings Authority, NERSA, is the scheme operator. The key principles of My Future Fund will be the pot follows the member approach to savings. So unlike occupational pensions, the pot is always in the employee's name, and it offers a minimal administrative burden for employers. So why is it needed? So recent CSO figures show that 56% of employees have an active pension. However, when you take the private sector out, when you just take the private sector on its own, the figure drops to less than 35%. So due to this low rate of pension cover, many people will see a drop in their living standards when they do retire. The launch details, as mentioned a moment ago, it will commence for pay dates from January 1st, 2026, and NERSA will review employee records in the run-up to this January 1st in order to deem who is eligible for My Pension Fund enrolment. So in terms of eligibility, based on information shared with NERSA, employees will be automatically enrolled if they meet the following conditions: that they're aged between 23 and 60, they earn more than €20,000 gross pay per year across all employments, and are not currently paying into an occupational or personal pension. Now, this must be through payroll, so anything outside of payroll won't be considered for this. And as additional notes, employees will remain enrolled even if their earnings later fall below €20,000. And for multiple jobs, eligibility applies only to roles without pension contributions, assuming other criteria are met. So, will new employees be auto-enrolled straight away? So, as such, there is no waiting period for auto-enrollment. So the process is NERSA identifies new employments through payslip data shared by revenue with them. An auto-enrollment payroll notification, an AEPN, is then issued if an employee is eligible for My Future Fund, and the eligibility tests are conducted on the data shared by revenue on a rolling 13-week look-back basis. So in scenarios, so employees with prior earnings likely to exceed €20,000 per year may be enrolled immediately, obviously subject to other criteria. And employees with no prior record or a gap in employment before this new job, they may have to wait up to 13 weeks while eligibility is established. In terms of deductions and contribution rates, so eligible employees must have their contributions deducted from their net pay. There's no tax relief applying to this deduction. The deductions are a fixed percentage of their gross income, and as such, every €3 contributed by an employee, the employer adds €3 and the state adds a €1 top-up. The result being that for every €7, sorry, €7 is added to the fund for every €3 saved. So can employees opt out? So auto enrolment, it's not actually fully mandatory, so they can opt out 6 months after enrolment during the 7th and 8th month, and also 6 months after a contribution change. So in years 3, it'll go from, in the previous slide, after year 3, it goes from 1.5% to 3%. At that point, there's a contribution rate change. So at that point, the employees can also choose to opt out. In the first scenario, there's a full refund of employee contributions. In the second scenario, so after the rate change, the refund is just on the difference between the new and the previous rate. The second option obviously will only be available for the first 10 years as the contributions are phased in. It's important to note that employer and state contributions will remain in the employee's My Future Fund pot. And after 2 years, opted out employees who still meet the eligibility will be automatically re-enrolled. Can the employees suspend their auto enrolment? So slightly different. Employees can suspend contributions at any time outside of the initial 6-month mandatory participation period. Suspension can be for 1 to 2 years. There's no refunds given as it's just deemed as a break in the payments. And once suspended, employees cannot resume contributing for a minimum of 1 year. So what's Big Red Book Payroll's role in all of this? So our payroll product, it will allow users to check if employees are enrolled via an AEPN lookup feature. This is similar to the existing RPN lookup that we do with revenue. Once an employee is confirmed as eligible via AEPN, the deduction will automatically be applied each time a timesheet is processed. If an employee becomes ineligible, they'll then be excluded from this after the AEPN lookup returns that status. The flow for making payroll submissions will now include the option to also make auto enrolment submissions. And payroll will also provide the ability to run checks on previous submissions to NERSA, similar to the ROS checks that already exist for revenue submissions. Now, how will contributions be paid to NERSA? So Big Red Book Payroll will send the amounts for the employee and the employer contributions via the submission to NERSA. After the submissions, employers must pay these contributions directly to NERSA. There's various payment methods, including variable direct debit, which are set up through the NERSA portal. The payment does become due with each auto enrolment submission. Now, this is a difference from settling your tax USC PRSI, which I'm sure you're familiar is on a date each month. The NERSA contributions will be settled per pay period. So if you're paying weekly, you'll get your bill as such shortly after each submission. Now, corrections to NERSA submissions. This is a large thing, a large item to be noted. So alterations to records submitted to NERSA won't follow the same correction process as revenue. NERSA are only going to accept changes to contribution submissions up to 6:30 p.m. on the participant's pay date. Any attempts to alter records after 6:30 p.m. will not be accepted. After this time, NERSA commence the relevant collection process. And this is in order to ensure that money is transferred into the investment managers as soon as possible. This ensures that the participants' My Future Fund pot has the best opportunity to grow. Now, so employer considerations regarding auto enrolment. So if you're going to avail of auto enrolment for your employees, I know it's not really a choice if they are eligible, but you can choose to make sure that they're not, and I'll cover that in a moment. If you're availing of auto enrolment for employees, there's a low administration burden. There's no need to engage with pension fund managers and providers. You, however, must still offer a PRSA, and employees taking up this PRSA will become ineligible for auto enrolment. The employer considerations around scheme administration. So NERSA determine the eligibility and applicable rates, so nothing to do for the employer there. Big Red Book Payroll will use the NERSA data to handle calculations and statutory submissions. No pay for an employee is no employer contribution, and employer contributions are deductible for corporation tax. And further considerations are employers wishing to implement an occupational pension to avoid auto enrolment must ensure that pension reported is via payroll well in advance, of the go live date. This cutoff is likely to be November, but it is to be confirmed. So just to cover that again, because I kind of tripped myself up, that if you wish to start offering occupational pensions to your employees to avoid auto enrolment, basically you need to make sure that you have those going through your payroll before the cutoff date, which is likely to be in November. So a pre-implementation review that employers can undertake is just to identify employees who might be eligible. So employees aged 23 to 60, earning €20,000 or more, who are not already in a payroll-linked pension. You can review the exemptions on offer from your company. So existing occupational pension schemes, PRSAs with payroll contributions. So if you offer an occupational pension after 6 months service, employees may still be auto-enrolled during their first 6 months. Obviously, that will be just down to other criteria as well. And you need to understand the opt-in rules for employees under 23 and over 60, or earning less than €20,000 per year, as they can choose to opt in. Just some financial and strategic preparation. Make sure you discuss all the options with internal and external advisors. Consider the cost of offering occupational pensions to all employees versus auto enrolment. Forecast your financial impact, remembering that it's starting at 1.5% and rising to 6% by year 10, and update your payroll budgets accordingly. Just in terms of registration and compliance, so it's a requirement to register with the NERSA employer portal. So it's a secure employer and agent portal to be released in Q4 of this year. That'll allow for the registration and the setup of your payment options and payment details. An active ROS cert is all that's required to log into this, and there will be a major NERSA communications campaign undertaken in advance of this. Now, so exceptions for employers in financial difficulty. Unfortunately, there are no exceptions going to be made under this scheme. Employers in financial difficulty should still, however, contact NERSA, and just reminded that a failure to make contributions is an offence under the Auto Enrolment Act. Just in terms of future plans for auto enrolment, so what might be coming down the road, Auto Enrolment Pension Scheme and its rules will evolve as it matures. Potential future developments do include the option for lump sum contributions, and then minimal occupational or pension cover. So by the end of year 6, there will be a minimum required level of pension cover to deem an employee ineligible for auto enrolment. This will be developed with the support of the Pensions Authority through NERSA. And there is also a consideration for auto enrolment for the self-employed. Just in terms of the current state pension as it is, the government are confirming that it will remain in place. It has just been described as the bedrock of this new system. Auto enrolment is designed to increase retirement savings, provide workers with a new way to save for the future, and not replace the state pension. Now, that roughly brings us through an overview of it. We just have some frequently asked questions that we've seen so far. So we'll start with what is deemed gross pay. Gross pay is anything that is in the gross pay field on payroll, and that will be accessible, such as basic pay or salary, holiday pay, employer sick pay, benefit in kinds, share options, lump sums, commissions, overtime, and bonuses. And then who is considered an employee? So for auto enrolment, an employee is the same as for tax and PRSI purposes. So that is that they work for and are paid by an employer, not self-employed, and the PRSI classes will be used to exclude the self-employed initially. The eligible PRSI classes are A, B, C, D, H, and J, along with some relevant subclasses, and there will be exclusions for community employment, so CE schemes, and income from pensions, which is generally PRSI Class M. In terms of will company directors be enrolled, and it does depend on the class contribution that the company director is paying PRSI at. So if they're paying as an employee and meeting the eligible criteria, they're enrolled. If they're registered as self-employed, currently they will not be eligible. Do employers need to inform their employees? So yes, they're legally obliged to inform employees when they've been enrolled, as well as informing them of the date of enrolment. And your Big Red Book payroll will provide an option to generate emails and PDFs to print off in order to share this information with employees. Is an employee eligible for an employee who is eligible for auto enrollment but going to join a pension scheme? So in this case, when after joining an occupational or personal pension scheme that's being paid through payroll, an employee will be deemed ineligible for the pay period after the first period in which the pension is paid through payroll. So as such, this means that the week or the month that the person is going to start paying into a pension scheme, they will pay both occupational or personal pension deduction as well as a My Future Fund deduction until such time as the AEPN is updated to reflect that they're now paying into a pension. Are there contribution caps? So there is a contribution cap of €80,000. It's not so much a hard cap in terms of how it's calculated. Once that cap is reached, the contributions stop after the pay period in which the cap is breached. So this can result in employer and employee contributions being paid on gross pay above €80,000. And there'll be no refunds made on contributions paid above that cap. So an example there of how that might happen, where contributions would be taken on pay above 80,000, is that an employee earns 79,500 gross to date up to September. Their October gross pay will be €2,000. So as such, their gross annual will be 81,500. NERSA will take and invest the contributions on the €2,000 October pay, and at that point, they will create a new RPN with a contribution rate of 0 for the remainder of the year, and then beginning from January of the following year, there will be a new APN issued with the correct rate again. That brings us through our presentation on the My Future Fund Auto Enrolment Scheme. Thank you for your attention. If you have any questions, we will answer them through the questions and answers button. I just want to remind you that this session is being recorded. It will be shared afterwards, including the slides and any questions and answers. And just in terms of your questions, just remember, we're not NERSA or DSP, and we will not be able to answer questions that relate to certain specific circumstances or why certain rules are a certain way.
Thanks, Dave. That was a really, really great session. Appreciate it. And there are some questions, so maybe if I read them out, you could answer them then. So first question from Warwick O'Sullivan. If an employee is already paying into a private pension, not being deducted through payroll, must they still sign up for auto enrolment?
So, Porrick, yes. So revenue will have no visibility of the private pension payment being deducted through payroll. So as such, it's not so much that they sign up to auto enrolment, but that they will be deemed eligible for auto enrolment because they don't have a pension payment going through their payroll.
Perfect, thank you. We have an anonymous attendee. Is the amount capped at €3 only, or can an employee opt to pay more?
So hello, anonymous. It's not so much that was just an example. For every €3 that the employee pays in, the employer matches €3. It is always going to be a percentage of gross pay, and that is fixed. So there's no option to pay above or below the percentage.
Perfect. We have a question from Nolene. Will the deductions be automatically picked up in payroll, or is it up to payroll staff to put in the amounts that are to be deducted weekly, monthly in the deductions tab, like we do currently with anyone who has pensions for EE and ER contributions?
No, Liam, they will be deducted automatically. So when you go to do your processing, if that employee, for each employee who has an active auto enrollment status, we will trigger the deduction from their net pay based on their gross pay when you're processing. So as such, there's very little administration to do on this.
Right, we have another anonymous attendee. Is an employee exempt from AE if the employer is only contributing into a private pension, but the employee is not? The employer amounts are shown on the employee's payslip.
So assuming that it is being reported through payroll correctly, the employer contribution to a private occupational pension is enough to deem it ineligible. So as long as it's been reported through payroll, there's no, it can be employee and or employer payments to a occupational or private pension.
Great, thank you. We have another one from Nolene. Regarding the cap of 80k and contributions will stop, does payroll pick this up, or do the payroll staff have to keep an eye on this?
So Nolene, again, everything comes from NERSA through the AEPN. So it's not so, like the example I gave, it's not that it will cut off directly at 80,000, it will cut off when the AEPN is issued after they exceed 80,000 for the year. But that will be picked up by the APN, which will be brought in by your AEPN lookup and then applied the next time you're processing a payment.
I have another one here from Anonymous. Is there a video on how pension is logged in the payroll software and how to set up a pension in the software?
So currently, no, there will be. We will probably do another webinar between now and Christmas regarding getting the details of how to use the software. There won't be anything really to set up in terms of, it will be just bring in your AEPNs, it will mark your employees as eligible, and the deduction will be automatically handled when you're doing your processing of timesheets.
We have one from Simon Gavin here. Where can I get details of the opt-in rules? So
Simon, if you go to, if you just Google auto enrollment, the gov.ie has a section on auto enrollment. There are several links that we will send out when we're sending out this in terms of DSP have a very good guide for employers, a guide for employees, and they also have a YouTube channel. We will share all of them after the meeting when we're sharing the slides and things.
Yeah, just keep an eye on your emails. That'll be coming in the next few days. From Don Rothwell, do employers have to register employees for auto enrollment, or do employees register themselves?
Nobody registers anyone. So the handling of this will be that revenue share the pay slip data with NERSA. So NERSA will deem eligibility based on what is currently being paid to employees and will issue AEPNs for anyone who's eligible.
Great. I have another one from Cecilia Lyons. Can an employee opt in if they are receiving less than 20,000 per year?
Cecilia, yes, in terms of they can opt in, but they would also need to be not paying into a pension through their payroll.
Some great questions coming in here. Thanks a million. We could be here a while. There's a lot more.
No, we'll stay a while. Absolutely, this is what it's for.
Absolutely. Anonymous, if an employee is over 60, are they to be enrolled?
They won't be auto enrolled. They can choose to opt in, but no, they won't.
Okay, perfect. Jackie Cuthbert, if a starter joins during the year, employer will get their EAPN through the portal like with the RPN currently received from revenue? Question mark.
The AEPNs will be updated based on the payslip data being sent to revenue. So once you register a new employee, they will start all the look back process and all that to deem eligibility. If they're deemed ineligible, there will never be an AEPN made available for them. But if they're deemed eligible, that AEPN will come in for the next time you're processing a payment.
Perfect. I have another question here from Roberta. If an employee begins paying into a pension and both this pension deducted through payroll and My Future Fund payment are deducted payroll date, will my future fund deduct be refunded now that the employee is not eligible?
Roberta, the short answer is no. The the technicality is that on the date you're paying them, they are still eligible for auto enrolment. They don't know that until the pension payment goes through on the payroll data and filters back to NERSA, they don't know to mark them as ineligible.
I have one from Bridie Cook. I'm a director of my company, but I'm also on the payroll. Will I have to auto enroll?
So Bridie, that just comes down to your PRSI class. If you're class A, yes. If you're class S, no. Amongst other things, I can't tell you for sure. I don't know all of your personal circumstances, but the long and the short of it is, if you're self-employed as a director, even though you're on the payroll, that could have you exempt. But if you're on the payroll as an employee, then you'd likely be eligible.
I have another one in from Anonymous. We have a few of them on today. Is there a standard letter to send to employees explaining auto enrolment?
There is, and we will, within the payroll software, produce that letter for you. We're going to offer the option to email it to people, or just create the PDF so you can then print off or email separately. But yes, there is a standard letter, and we will create it for you.
Great. I have a good one in here from Elizabeth Fogarty. Do all employers need to register on NERSA? What is involved here?
So, short answer, yes. The not so short answer is we're still waiting to find out what is involved. NERSA will undertake a campaign in the coming weeks and months to tell you what is involved to register. It is a portal. It'll be similar to Ross. You'll log in with your Ross cert and things like that. You will be able to check previous submissions and all that kind of thing that you can do on Ross also. But the finer details of how to do it we're still awaiting from DSP and NERSA.
Great. One in from Lynn Bannon. Am I to understand that a statement due to NERSA will be generated in Big Red Book, whereby you will have access the NERSA portal and pay this?
I'm not sure I fully understand that. If don't mark that was answered yet, I'll keep reading it, Catherine.
Lynn, you might just give us a bit more information on that one. I'll move on to the next one.
So, well, the statement due to NERSA, so that the amount due to NERSA won't be generated by Big Red Book. It will be generated by the submission of Big Red Book to NERSA, and NERSA will then bill you back for that particular submission. And that will be paid based on how you set up to pay your bills through the NERSA portal. So you won't have to, unless you choose to do it through the portal, you can set up direct debits and things like that, but you won't have to log into the portal if you're paying by direct debit and things like that. If that doesn't answer your question, Lynn, come back to us, see if we can give you better clarity.
Thanks, Dave. There's a couple of kind of similar questions around this one. So just from Sandra Brannigan, if an employee is not eligible but want to auto-enroll, how do we bring this into Big Red Book?
So again, it doesn't matter that they want to auto-enroll. They can do that themselves. It's not done through payroll. They will go on to their employee NERSA portal, and they will request enrollment themselves, basically. That'll then be checked because they still have to not have a pension and things like that for the employment. So there's nothing to do in payroll if someone wants to opt in as such.
Anonymous attendee, hello. Is this correct? The contribution is calculated from gross pay but paid from net pay.
That's correct. So it's a percentage of the gross pay is the deduction, and it's deducted from net pay. Basically just means that there's no tax relief as such on the deduction. The tax relief is taken to be the government top up.
Another one here. If you decide to opt out of auto enrollment after 6 months, do you get a refund of only what you've paid in, or what the company and government have paid in also?
So if you opt out after 6 months, you just get what you've paid in back. The government and the employer contributions stay in your My Future Fund pot.
From Carol Lynch, if an employee has a private pension, will they still receive their tax-free allowance on that or only on the new system?
Probably a question for NERSA DSP, but my understanding is that there is no tax relief on the NERSA pension, but obviously there's implications down the road. If you have multiple pensions, your final pension pot combined might be different. So it's probably something you need a bit more advice on. But as such, the it doesn't affect your relief on your pension as it currently stands.
We have another one from an anonymous. Do we have a date for the NERSA portal going live? I think you've kind of alluded to that it hasn't been confirmed yet.
It has not been confirmed yet, unfortunately. They are working away very busy like ourselves in the background to get all these things ready for the go live. And it will be obviously in advance of the go live, but we're not sure how much longer it will be.
Another one in here from anonymous. Will we receive training at Big Red Book if any changes or additions are needed in NERSA? So I can take that one, I suppose, Dave. Yes, we will, of course, be running more webinars. We will be doing FAQs. We will be doing how-to videos, and we'll send them all, obviously notify you as per normal via email. So keep an eye on your emails over the next couple of weeks and months. And as we have more information from NERSA and have dates and stuff like that for their release, we will let you know so you're aware of it as well.
And just to follow up on Catherine's point there, is that this is on the surface quite simple to administer in payroll. The file will come in, it will tell the software to make the deduction, and the deduction will go across, and then you pay your bill. It's massively oversimplified that way, but there won't be an awful lot of manual reconciliation in terms of is an employee signed up or not, all that kind of stuff for you to do as a payroll operator.
Thanks, Dave. Question from Michael Andrews. Can part-time workers avail of the scheme?
So technically, yes, but again, it comes down to the 23 to 60, the €20,000 earnings, do they have a pension, that kind of stuff. So assuming they meet eligibility, it doesn't matter if they do 5 hours a week or 40 hours a week, that they will be all considered for eligibility. And then the part-time casual workers, relief workers, anything like that can also opt in separately, even if they don't make the automatic auto enrolment criteria.
I have a question here from Sheila Anna O'Leary. Sorry, everything's just jumped there. So when you register a new employee, you will need to have the private pension or PRSA already set up so as to avoid auto enrolment.
So there's a little bit of a catch here in that NERSA don't know there is a pension or PRSA being paid through the payroll until you pay the employee with that deduction and it gets reported to revenue. However, they also don't know that they are set up to be paid until such time as the payroll goes through. So technically, the first indication that they get of the employee will also include the PRSA or the pension deduction, so they will know at that point. But it is possible, if you were to register a person too far in advance, that they could filter through the system and meet the eligibility before the pay slip is sent through with a PRSA deducted from
it. Thanks, Shilan. I have one from Carmel Lynch. If someone is not enrolled in a pension and don't meet criteria for auto enrolment, can they opt in? I know it's been asked, but it's coming up a few times. I said we just recap on it.
That's fine. So if they're not enrolled in a pension and don't meet the criteria, can they opt in? So once they're, excuse me, once an employee is not having a pension paid from the payroll and they're ineligible due to other reasons, their age or their earnings, they can choose to opt themselves in.
Great. From Eileen McEnroe, you mentioned a November deadline to either opt in or out for PRSA or AE. Can you recap on this, please?
So it's not so much a deadline, it's just that if you as a company don't currently offer a pension and you're going to choose to basically give all your employees some sort of pension, in order to not have anyone auto-enrolled, because there will be a look back done by NERSA, there will be a date that's expected to be in November where you'll need that data to be in your payroll by then, or else you could run the risk of come January that they are not quite meeting the criteria of being ineligible for auto-enrollment.
Just another one here, and I think we've kind of answered it, but we'll do it again just so everyone is aware. Does NERSA have a website? So obviously there is, I think you mentioned, a lot of documentation. There's a YouTube channel, and we will include that in the slides and the recording of the webinar, so you have it to hand.
If you're going looking yourself, a lot of the information is on gov.ie, and it's sort of a part of the DSP section of gov.ie. Basic Googling for auto-enrollment guides and things like that will find gov.ie links that will get you some very, very valid information. That'll do you in the meantime. We'll send on the ones we know to be the better ones in the coming days.
Thanks, Dave. Elizabeth Fogarty, do the same opt-out rules apply to employees with own personal pension, not through payroll, or can they do this before it's automatically picked up for the first time via a UPN?
So to just apply. So the only way to be unenrolled once you're enrolled is either to opt out or to allow the pension payment to filter through the system. So for this example, if your employee, sorry, it's gone off my screen now. If your employee is paying into a pension, sorry, it wants to opt out, they can opt out within the windows. Otherwise, if they start paying into a pension, the first week that they pay into that pension, the first pay slip week or month that they pay into that pension, they will pay both, basically, because NERSA does not know yet that they're going to pay into a pension. It's a bit of a quirk of the system, and there is no way around it because the legislation doesn't allow us to say we know there's a pension payment, so we're not going to take the auto-enrollment. We have to follow the AEPN directive.
Great, thank you. We have a good one here from Patricia Walton. Will employees have access to view their payment record on the NERSA portal, or will there be a version of the portal specific for employees to view?
Yes, there will be an employee portal, and it is our understanding, we haven't quite seen it yet, that it will be very similar to what you have for your Revenue My account and things like that, where it gives all the details of what is happening for you. It will also be on the pay slip and things like that. So they will know that it is being deducted, and then they can check it against their portal record.
Great. One in from Liz Carroll. If an employee has 2 or more employers, do both employers need to register and contribute?
So Liz, every employer needs to register. That's that. There's no way around it. You need to check that you have no employees who are falling through the cracks of whatever you do offer, if you are deeming that you won't have anyone. If they have 2 or more employers, you can technically say, if I have 2 jobs, I have a pension with one and no pension with the other, I could technically, meeting the other criteria, be auto-enrolled for my second job and be paying into my pension in my first job.
Yes, there's a good one there. How does the opt-out process work, and how early can an employee opt out if they request this from month 1? That's from Vanessa Burke.
So Vanessa, for start, you can opt out in month 6 or 7. That's how the process works. And it's not a permanent opt-out, you will be re-enrolled afterwards. So when the scheme sets up, 6 months later, they can choose to opt out at that point, but they will have been paying in for 6 months. At that point, they'll get a refund of their contributions, but the employer and the government amounts will stay in the My Future Fund pot for the employee.
Great. I have one from Anonymous now. It may not be for ourselves, but you can let me know. For a part-time employee who will turn 60 at the end of the year and whose salary fluctuates monthly, are likely to reach/exceed the 20k by the end of the year, will they be enrolled now, or what steps need to be taken?
So yes, that is a question for NERSA DSP. As such, they're turning 60 at the end of the year, so they're currently under 60, so that makes them eligible. Their earnings, if they're deemed to be over €20,000, that would make them eligible. So they would be eligible until they're 60. But again, there's a couple of little things going on there, so you should really get advice if you want an answer on that.
Dave. One from Sharon Ball here. With a start date for 1st of January and a 13-week look back, would it be identified if a private pension was deducted for the first time in December that this employee be excluded from auto enrolment?
This is when we were talking earlier about the cut-off of around November time. We're not sure at what point that cut-off will occur. They're obviously going to try and leave it as late as they can, but they've an awful lot of data to get through. So there will be an initial cut-off somewhere around November time. So in your example, the December one would deem them eligible in January, but after their first one, they'd likely be deemed ineligible as there'd be a pension against it.
Now we're getting there. There's a few more. I think we've answered a lot of these. Maybe this one again, because it has come up a couple of times. If a PRSA is set up, does the employee have to do a minimum of 3%? And does this have to increase in line with the government plans?
So no, as such, currently there is no kind of minimum standard for what's deemed a relevant pension or PRSA. By the end of year 6, there will be a basic requirement set, but currently it doesn't matter what they're paying in. It can just be the employee or just the employer paying into the pension. But once it's going through payroll, that's enough currently.
Yeah, just bear with me. I think we're getting, there's a lot of kind of duplicates here, so I don't want to make sure we're getting to the right ones. Does each employer have to register, or are all employers automatically registered? You have to register yourself. Am I correct on that, Dave?
You are correct. So technically every employer has to register because there will be a requirement for payment details and things like that. The details will be shared by NERSA. They are saying there will be a major campaign to contact every employer in the country in multiple platforms before they need to register, to inform them of how to do it and when to do it.
Thanks, Dave. Marguerite Curran, if you decided to opt out, does the employer and the government still make a contribution for you?
So from the time you opt out, no, all deductions and contributions stop. So if you opt out in your, like we were saying, in month 6 and 7, from that time there'd be no deduction for you. However, whatever has been deducted as a contribution previously will remain in your pot from the employer and the government top
up. Kathy Tong, if you have a non-national on a student visa, he's just graduated and employed by us, does this apply to them? NERSA?
NERSA, but in general, if they're an employee, they may be deemed eligible.
If a person has maxed out their private pension, can they still participate?
Oh gosh. So because of the 13-week look back, if you max out your private pension well in advance at the end of the year, technically you could become eligible. But at that point, only at that point, you couldn't opt in because you would be seen to have been paid into a pension previously.
One from Anonymous here. What happens to the person's pension on death? Has that been?
So that hasn't fully been covered, but it is a question for NERSA DSP. It does not die with the person. There will be, the legislation does cover what happens in death, where it just hasn't been specifically set out yet in anything but the legislation. So they need to just decide what it truly means before it's shared.
Okay, and kind of tying into that from Carol Lynch, at what age can employees access the pension under the new system? Has that been confirmed?
So the intention is at retirement age. So whatever your retirement age is for your state pension, but again, it is going to be managed by pension providers, or sorry, pension managers, and there will obviously be options for various things as the scheme progresses. But certainly initially it is on retirement, on say 66, if that's your statutory retirement age.
And that'll be paid obviously through the pension funds, not through the payroll.
That would be paid, yes, through pension funds, yes.
If you set up a new private pension and you were previously AE and deductions from your new private pension are going through the payroll, will the AE contributions automatically cease, or do you have to reach out to NERSA?
So this is covered by the submission going to NERSA. So NERSA, the first pay slip that you make the private pension on, there will be a private pension deduction and an AE deduction. But once NERSA see that you're paying into a private pension through payroll, they will issue the ineligible AEPN.
But there could be an overlap where you're paying both.
There will always be, if you are auto enrolled, there will always be an overlap if you start paying into a occupational pension through work or PRSAs.
Great. From Anonymous, if an employee terminates their employment and moves on to another company, what happens?
So couple of ways to look at that. The pension pot is the employees, so it just moves with them from job to job. If the employee terminates the employment, they just stop paying. So as long as there's no gross pay going through the first employer, there's no deduction to be made. And as soon as they start getting their gross pay from the second employer, the eligibility will be assessed again through that, and we'll go on from there. But the pot itself follows the employee. So other than you make your ceased submission as you already do for Ross when employees leave you, that'll have enough detail in it to make to let NERSA know not to expect any more deductions for the employee in this employment.
Great. There's a lot of questions kind of around someone who's over 60, whether they can opt in, opt out. So you might just kind of cover that briefly again. So one question is, if someone is over 60 on a statutory pension but continues working, can they opt in? And this is a few questions around kind of the
so
age.
In this example, I'm assuming the statutory pension is the state pension. So technically, yes, if they continue to work, they would be considered for auto enrolment if they wanted to apply for it. But as they're over 60, they would need to choose to opt in. And at that point, the pension income would not be deemed part of their income either. So it would just be say if they were just took up a part-time job in a shop once they turned 60, it would just be that one job that would be considered, not any of their pension incomes in terms of their eligibility.
Okay. I've one here from Natalie. What happens when processing holiday pay and sick pay as the gross amounts will differ?
It's still a percentage of the gross amount. So say you're paid €1,000 gross and you're paying holidays in advance, so it's a week's holidays in advance. So this week's gross is €2,000. It's just a deduction of €2,000 as a percentage. It will automatically calculate the percentage based on the gross pay total for the payslip.
Cool. I've another one there from Nolene Ryan. If an employee moves employment and was AE on previous employment and moves to the new employment, does the opt-out begin after 6 months again, or does it carry on?
So if they move employment, they're on AE, yes. So it is 6 months from when you were deemed eligible is the first opt-out window.
Okay. Can a payroll provider agent register with NERSA as an agent for clients and carry out tasks, payments, etc., similar to Roz? That's from Elizabeth.
The short answer is yes. The long answer is obviously check it out yourselves in terms of there's lots of ways to set up an agent, and sharing Ross certs with agents. Some places do it slightly differently to what might be deemed the norm. So it is fully set up to allow agents be say a payroll agent continue to do the submissions for auto enrolment also.
A good one here from Brendan Cullen. Will an employee be liable to pay tax on their pension when they reach retirement age, even though they haven't received any tax relief on what they paid in? Might be one for NERSA, but
Brendan, it is a question for NERSA in the long term, but the short answer currently is that the employee can take a 25% lump sum from their pension pot on retirement that is tax free, and after that, it will be like any other payment that it may be taxable afterwards.
Great, thanks, Dave. I'm conscious, obviously, we are slightly over time, so I might just do one or two more, and then we'll wrap it up. Obviously, we will, of course, send all of the Q&A along with the slides. So any questions that we didn't answer, we will answer them and send it with all of the documentation. So let me see. From an employer point of view, is the full contribution they make deducted from corporation tax or a percentage?
That will be a question for your accountants, and maybe perhaps NERSA can answer it also.
Okay. From Sandra Brannigan, can an employee pay 6% on day one and the employer has to match this, or does the employer pay 1.5%?
No, so that table we shared earlier, they are set in stone currently. The percentage is the percentage, and there may in time be the option for lump sum, but our understanding is a lump sum will just be from the employee. There'll be no rule where the employer has to match a lump sum addition. But the system is a percentage set by the AEPN that's the same for everybody at the time.
Great. Just do one more from Kitty Ryan. If the opt-out is not permanent, how long before you are auto-enrolled again? And can you opt out a second or third time?
So if the opt-out is not permanent, so we had that. See, can I pull up that slide again? Sorry, 1 second now. The employee can opt out after 6 months after enrollment, and then will be re-enrolled after 2 years. 6 months after the 2 years, they can technically opt out again and enter into another 2-year waiting period. But they will be enrolled for the 6 months in between.
Okay, perfect. Thanks, Dave. I think that's pretty much all of the questions there that we have. As I said, we will, of course, just do a couple of edits and get this out on email to you. So you'll have the full webinar, the slides. We'll send all of the links to the to NERSA, to the YouTube channel, etc. But obviously, any questions at all, always feel free to reach out to us. Thanks a million, Dave. That was really, really great. Appreciate it.
And thanks for all your attention.
Thanks for attending, everyone. Appreciate it.
Thanks, everyone.
Bye.